I'd like to spend some time talking about the international equity market. Again, why am I talking about international equities? Well, I'll use my stacking principle again. If you put a stack of all U.S. companies and the value of them over here, and you had another stack of the international companies' values, the international company's value is a bigger stack. So we got to address that. It's probably in your portfolios. Maybe it should be more, maybe less. How do we understand international markets? How do they differ from U.S. markets? They do differ. The first thing I would say is let's define the international markets. There's basically two different divisions. There's something called EAFE, or Europe, Asia, and Far East, developed countries. This would include Western Europe, Japan, South Korea, Australia. These are the kinds of countries, stocks that are in that index. The other index is called the Emerging Markets Index. That would include China, Brazil, Russia, India, and smaller undeveloped companies in these different countries. So there's actually two areas of the international market, and they move differently too. Now lately, again, as of the taping of this, the international markets have been suffering because energy prices are down, and a lot of these emerging market countries rely on natural resources. They don't produce a lot of software and medical technology breakthroughs and all that kind of stuff. They maybe pump a lot of oil or mine a lot of copper or something of that nature. So they're going to move differently. They're going to move more with commodities. The international markets also can have a different take, the developed markets, I'm saying, on the global economy based upon how their countries are doing, how their currencies are doing. Now, investing in international markets can be more volatile than the U.S. market. But why are we looking at them right now? A couple reasons I can think of is one, is they're vastly undervalued based upon their 5-year forward PEG ratios. Their earnings and growth of earnings relative to what you're paying for them are vastly, you're getting at a big discount to fair market value relative to the U.S. market. It's tough to buy when something's down though, isn't it? How do you get excited about something when you look at the chart? It's been down, 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 down. Well, that's probably the best time to buy. So it's good to look at these areas. They're also sometimes more volatile. So you might say, maybe I don't want that. But if you look back the last 15 years, the emerging markets have been the best place to have your money. The proliferation of the middle class in China, India, Brazil, across the world, we've seen a real influx of new industry and demand from a burgeoning middle class we've never seen before. Now, one thing I would like to point out about any kind of equity markets, U.S. or foreign, a lot of people say, gosh, the markets are so overvalued. They've gone up. But if you look at our GDP growth, it's very small. So how could that be? Well, my response is corporations 15 years ago had about 1 billion people on this planet that could afford goods and services. Now with the proliferation of the emerging market countries, there's about 3 billion people that can afford goods and services. Never in the history of mankind have we had a 200% increase in the amount of people that can afford stuff that corporations make. Not only that, but technology has increased, so companies can do more with less. Payrolls have decreased. Interest rates are all-time low, so when they borrow money, they don't have to pay a lot of interest. So you combine all of these factors, so even when the U.S. market or gross domestic product isn't increasing, bottom lines of corporations are increasing at a dramatic rate. When they increase, so does the value of their companies. So globally, we can't look at it like we looked at it maybe 20 years ago. We have to analyze where is that growth coming from and understand how the different global markets interplay, understand how the currencies interplay, and take away maybe some of that currency risk. We don't want to invest in rubles right now, for instance. We gotta, if we want to invest in the companies from certain countries, we want to get it into US dollars first. Don't expect you to pick up too much on how to exactly do currency investing through this, but I just want to make you aware that there are a lot of factors when you're building, again, a diversified portfolio of secure investments, U.S. equities, international, both EFA and emerging markets, bonds, and alternative areas of the stock markets. These are things that you'll want to consider.